Hi all, welcome to my channel InfoCris. Today we will cover a crucial topic that every finance enthusiast, student and professional should master: ratio analysis. In this video, we will break down what ratio analysis is, why is it important, and how it can help you understand the true story behind financial numbers. Whether you are preparing for an exam, acing a job interview, or simply exploring the world of finance, this video will equip you with the essentials. So, grab a notebook and let's get started. First of all, let's understand the basics of ratio analysis and why it's a key tool for financial decision making. Ratio analysis is a financial evaluation technique that involves analyzing the financial statements by calculating and interpreting various ratios derived from the company's financial statements. If we look at this definition closely, we will see that the key is to analyze ratios derived from the company's financial statements. Thus, ratio analysis is a systematic method of evaluating the financial performance and condition of a business by analyzing the relationships between various items in its income statement, balance sheet, and cash flow statement. It serves as a diagnostic tool enabling stakeholders to assess various aspects like profitability, efficiency, liquidity, and solvency of a company to make informed decisions based on these insights. Now, once we know the definition of ratio analysis, let's look at the main types of financial ratios. The main types of financial ratios include liquidity ratios, profitability ratios, efficiency ratios, solvency ratios, and market ratios. In this video, which I have named Part 1, we will understand the liquidity ratios, which are also known as the short-term solvency ratios. For the rest, I will release separate videos. Liquidity ratios are financial metrics used to measure a company's ability to meet its short-term obligations, such as paying of bills, salaries, and creditors, using its liquid assets. Now, what are liquid assets? Liquid assets are the assets that can be quickly converted into cash without significant loss of value. They are essential for maintaining short-term financial flexibility and meeting immediate obligations. Examples of liquid assets include cash in hand, cash in bank, cash equivalents, accrued income, promissory notes, marketable securities, accounts receivable, short-term investments, certificates of deposits, etc. Now, we will look at the key liquidity ratios. The key liquidity ratios are current ratio, quick ratio, and cash ratio. These ratios indicate whether a company has enough liquid assets to sustain day-to-day operations and settle the liabilities without relying on long-term financing or asset sales. First, let's look at the current ratio. It measures the ability to meet current liabilities with current assets. Thus, current ratio is equal to current assets divided by current liabilities. As we know, current assets are the assets that a company expects to convert into cash, sell, or consume within a normal operating cycle, usually 1 year. They represent the resources available to meet short-term obligations and support day-to-day operations. Current assets include cash and cash equivalents, accounts receivable, inventory, marketable securities, prepaid expenses, short-term loans and advances, and other current assets like accrued income or refundable taxes. On the other hand, current liabilities are the short-term obligations or debts that a company is expected to settle within a normal operating cycle or 1 year. Current liabilities include accounts payable, short-term debt, accrued expenses, unearned revenue, current portion of long-term debt, taxes payable, dividends payable, and other short-term obligations like customer advances or provisions. Normally, a current ratio of 2 is considered as ideal, though it can vary based on the nature of business and other factors. This means current assets should be at least 2 times the current liabilities. Next is the quick ratio or acid test ratio. It measures the ability to cover current liabilities with the most liquid assets. Quick ratio is equal to quick assets divided by current liabilities. This is a more conservative measure for evaluating short-term liquidity. Ideal range for quick ratio is 1. It measures the ability to cover current liabilities with the most liquid assets. Here, quick assets is equal to current assets minus inventory minus prepaid expenses. Next is the cash ratio or absolute liquidity ratio. This ratio considers only those current assets which are readily available to the company for paying off debts. Thus, it evaluates the ability to pay off short-term liabilities with only cash and cash equivalents. Thus, cash ratio is equal to cash and cash equivalent divided by current liabilities. A company is considered as financially sound if it has a cash ratio of 1 or more. Hope you have understood these ratios. In the next parts, we will learn the other financial ratios in detail. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.